In this special edition of 10 with Ty,
So Ty and Hyde, Washington Brown.
Hotspotting's Terry Ryder puts me under the microscope.
So do you have a basic philosophy that underpins your property investment?
Yes, I like to buy when other people aren't.
Find out my biggest tip when it comes to buying property.
Independent advice on where to buy is key.
It's all coming up on 10 with Ty, the special edition. Hi, I'm Ty Hyde, the CEO of Washington Brown, the property depreciation expert. Now I'm a qualified quantity surveyor and also a best-selling author who's helped hundreds of thousands of property investors over the years pay less tax through depreciation. I'm also an avid investor, which is why I created the podcast series 10 with Ty, where I ask the smartest people I know the same 10 questions to unlock the keys to their success and hopefully leave a playbook for my family and your family too about investing. Now this podcast is general in nature and not specific to your financial circumstances. We always recommend you sit down with an accountant or financial planner before making any investment decisions. Now, let's get on with the show.
So Ty and Hyde, Washington Brown. You know a lot about depreciation for property investment. I think you more broadly, you're in your own right, you've been a property investor for most of your adult life. Do you remember the first one? What it was, where it was?
I certainly do. Yeah, I certainly do. Hi Terry, thanks for having me on. It's probably one of the best investments I ever made, believe it or not. It was in Balmain. It was a 2-bedroom, 2-bathroom, 1-car space. I paid $249,000 for it. But the thing was, I was actually the quantity surveyor on the project on behalf of the bank. So when you borrow as a developer $10 million to do a development, the bank just doesn't give you $10 million. They'll say they want an independent valuation of the overall project and they want an independent valuation of the construction cost, which is what me as a quantity surveyor used to do. So we'd go out every month and pay certify the amount of work done on that progress, on that project on behalf of the bank. Problem was the builder went broke. And so at that time, before he went broke, I put $1,000 down on this apartment as a holding deposit. The builder went broke, and it took like 3 or 4 years to finish the project, and I helped project manage the job to completion. By the time it finished, there was enough equity in that. There was enough equity from the 240 that I didn't have to put any more money in. So I only put $1,000 down, and I borrowed the full amount because they based it upon the new purchase, the new valuation. So when I sold it in 2001, it already went up to about $500,000, and so that $1,000 turned into like $250,000. So the return on equity or return on investment (ROI) was huge. So if you look at it purely from that point of view, it turned out to be one of my best investments ever.
Yeah. What would it be worth today?
1.5. But that, if we look at it from another point of view, you know, people say probably doubles every 7 years or 7 to 10 years. So that was 2002. So so it would have been 500 to 1 million to 2 million. So 1.5 wouldn't have been bad, but you know, I don't regret selling it because whenever I've sold a property, I put it into another property, into a bigger and better property. And I put that money into a 2-bedroom unit in Bondi that for about $860 and sold that recently for $6 million. So that wasn't a bad investment either. Yeah.
So that's a good segue into my next question, which is about your basic strategy with property investment. Is it some people try to trade their way to success, what you've just described. Buy something, sell it for a profit, buy something better.
Yep.
Is that the way to go, or should people just buy good asset, keep them and accumulate a portfolio?
For me personally, I've been more of a trader. Because I'm in property, I've been able to see deals that other people might not be able to see. For instance, I'll give you an example. Once I was at a trade show and there was 200 people lining up in the morning to come and see a property expo, right? I thought, this is crazy. This is the peak of the market. So that next day, I sold the next week I put about 3 on the market, the ones that weren't that good, because when things are really booming, it's a good time to get rid of some of the shitty stock that you might have, right? Because that's when you want to get rid of that stuff. It's, when times are good, things sell, but when times are bad, sometimes it's harder to get rid of the not so good stock. For the average person, look, I believe their strategy should be to accumulate and hold would be the most easiest way, because the problem is with trading properties is that there's a lot of entry and exit costs. You know, it can be at up to like 10% of the purchase price of the purchase price getting in with stamp duty, buyers agencies, selling costs, marketing costs. So that's something to be very wary of.
Yeah. So do you have a basic philosophy that underpins your property investment?
Yes, I like to buy when other people aren't. So that would be my number one thing that I've learned over my life, is that property goes in cycles, and ignore the media. There will always be a bad time, like there will always be a good time, but there will always be a bad time. And I'd rather buy when no one's at an auction than when there's 100 people at an auction. Now that's hard to sit in the moment, because at the moment I'm like, if I was to buy something, I'm not looking to buy at the moment, but if I was, it'd be like pretty tough in Sydney, because it's going through a bit of a boom again. Like there was an auction yesterday in Surrey, in Paddington, where a unrenovated semi sold for $9 million in Paddington. Unrenovated semi sold for $9 million, right? $1.5 million over reserve. So that top end's really going bananas here. You know more about that than me. So at the moment, it'd be really hard in Sydney, because I can't see that property prices are going to come back a bit. You know, I'm pretty much Sydney focused, because that's where I live. But I just find it hard to believe that property is going to come back at the moment with you know, migration where it's going. You've got building starts 20% down year on year, right? So we're not building enough, Terry. That's the problem at the moment. Supply is clearly the problem in this market.
Yeah, well, the shortages of everything that matter in real estate. We're not building enough. There's not enough listings of properties for sale. There's not enough rental properties available for tenants.
Yep.
And that's putting that constant upward pressure on prices and rents.
Yep.
Yeah.
I got an Uber here today, and I asked him, I said, "Oh, where do you live?" And he said, "Alexandria." I said, "All right." He goes, "But I'm moving." I said, "Well, why are you moving?" He said, "Well, they're charging me $600 a week rent for a one-bedder. They've just put it up to $850 rent for one bedder in Alexandria." I'm like, how do people live? You know, it's pretty tough.
I know. And unfortunately, the politicians don't seem to have any solutions to the rental shortage, which they created. Yeah. But what you're speaking to with what you said earlier is about being counter-cyclical with your approach. I think far too many people get into property investment as herd animals, following the herd into a stampeding into a boom, perhaps.
Yep.
And it seems to me that's the antithesis of good investment strategy.
Let me tell you a story. Okay?
Okay.
So one of my clients is Harry Triggerboff, who's the richest man in Australia, is worth $26 billion. He said to me at lunch one time, he said, "Tyron, do you want to know the secret to my success?" I'm not going to say no, am I? "Yes, Harry, what's the secret to your success?" He said, "Tyron, when times are bad, I buy land. By the time I get development approval, times are good again." So simple. Why didn't I think of that? Helps having $26 billion though, I guess.
Yeah. So it seems to me that one of the problems that why so few people, we're talking about the 1%, and that refers to the fact that of the 2-point-something million Australians who own an investment property, only, less than 1% actually own 5 or more. 90% own just 1 or 2. Why do you think that is? What's holding people back from being more successful with something that so many Australians are passionate about?
I guess the easy answer is money, but I think a lot of people get burnt on the first time. I think a lot of people make mistakes in their first early investments, and I see it all the time, because we analyse a lot of properties, what the original sale price was and what the new sale price was, and we find that so many people, for 10 years, it's just flatlines, because they've bought into maybe a house and land package off a property spruiker, and it's just flatline for 10 years. They haven't made any money. Unfortunately, then you see, bang, they sell it after 10 years. That's when the growth starts to happen. Now, a lot of people that are selling those type of stock, they tell their clients they've got to hold it for 10 years. And you know why that is, Terry? Because it takes 10 years for them to get to what it's actually worth, right? And sadly, if that happens, you're not going to go back into the market, because you're geared so much in property. A 10% variance in price can wipe you out. Like if you bought a $500,000 property, you put in 50K, it goes back 10%, you've lost everything. Plus you've lost your stamp duty, so you've actually probably lost more than 200% of your initial investment. And it's not unusual that property can go down 10%. There's a myth that property always goes up. Complete myth. It goes up and down, Yes,
of course. So the fundamental importance of getting the first one right and getting it wrong is what holds so many.
Yes, because then once people get it, if they get the first one right, then they can take equity and kind of accumulate more properties. But if you make the big mistake at the beginning it's really hard to recover.
Would you agree with this, that one of the reasons why people do make mistakes with their first one is there's a reluctance to spend money on advice and information?
Yes, look, I would agree with that. And I guess these days, I guess there's a lot more buyers agents that have hopefully a network of people that can help them and research them. But I think the basic starting point for everyone that ever wants to buy a property should be RP data. They should have access to comparable sales to see that what they're paying is what it's worth. And my advice to someone would be to buy a property that's generally 10 years old, right? The reason is you can actually see what the other comparables are around that time for 10 years, for a 10-year-old property. So you can see the real market value of what it's worth yourself. I had Chris Gray on my podcast recently, and he insists, he's a buyer's agent, he's a successful buyer's agent, he insists on every one of his clients getting a valuation before they buy that property. He's like, you get a valuation for a car, but you're going to spend $1 million on a property, you don't want to even spend $600 on a valuation report? It makes sense. So getting that information is key to getting that first successful investment. So for me, a no-brainer for an investor would be to have access to comparable sales via RP data.
So spending money on information.
Absolutely.
Spending money on perhaps advice from a good accountant, make sure you're buying the right structure. Yeah. And
spending money on a Terry Ryder Hotspotting report. Now, I'm not just saying that because you're sitting here. What I would do if I was an investor, I would get your reports, I'd get SQM reports, right? Maybe some RP data reports, and heat map them and see what areas you all agree are the new hotspot, right? If all three of you are saying, go and buy Yamba, I'm thinking Yamba's pretty good. Because you guys, that's what you do. Independent advice on where to buy is key.
10 with Ty is brought to you by Washington Brown, the property depreciation experts.
So what we often say to people is build your team before you build your portfolio. Is that a philosophy that you would agree with?
It's good in theory. However, if you're a first-time investor, right, and you don't have any properties at all, you're not going to get a lot of airtime from going to an accountant or to a property manager. That's where a buyer's agency comes in, who's referring 20 people, a month to these people. But yes, obviously once you have a portfolio, having a team is vital. Like for starters, a mortgage broker is unbelievably important. Getting access to funds is vital.
Yeah. So accountant, mortgage broker, quantity surveyor.
Lawyer, independent legal advice is very important. Financial planner or accountant, financial planner, but again, data, property data that's out. That would be my starting point. I never buy a property without looking at RP data and seeing, RP data even gives you a valuation of what the medium value for that property is. Once you're in there, it'll say, okay, this is a low end range, high end range. This is where you should be paying, or the middle range. That's pretty key.
Okay. So, Tyron, if you go back in time, what advice would you give to the 25-year-old you starting out perhaps with property investment? So, I guess along the lines of what Harry said, do the opposite. My advice, my strategies tended to be do the opposite of what everyone else is doing to make money. So definitely don't follow the crowd. Like when I see in the newspapers for months that, oh my God, properties are going over, 20% over reserve and stuff like that, I'm just, I'll just wait, thanks. So sometimes the best advice would be to do nothing in investing, if you ask me. Sit back and wait. It is a myth, this myth of it's time in the market. It's time in the market. All the successful people I've ever met in my life, sit back, wait for bad times, pounce with money. So cash is king. And that's a very interesting philosophy because it's quite the opposite of what so many people preach. So many people say it's not time in the market, it's time in the market.
The real money.
Actually, it's both probably.
Absolutely. The real money that I've seen, the huge wealth, like the richest people in Australia, they're not sitting there going, I want to buy a bank share with a 6% dividend. They're waiting for a property fund to go broke and then say, bang, we'll buy it, thanks. They are. That's with cash. And I've seen it many times. So that is my strategy, but to be sit back, do nothing, wait. Because, following the crowd is not an ideal investment strategy.
In 2023 and 2024, have been seeing a lot of people piling into the Perth market. Very much doing what you're suggesting people shouldn't do, competing crazily for property. Properties are selling within days of being listed, well above the listing price, not doing the usual due diligence, building and pest inspection. seems that people are stampeding as part of a herd, setting themselves up for problems down the track.
So nothing really dramatically changed 5 years ago. That market was still sitting there for a long time dormant, wasn't it, right? Why weren't people buying then? Like, that was when you should have been buying, not now when everyone's thinking, oh, Perth's, got to catch up. So yeah, that's an interesting market over there. I don't know that market that well, but I've started reading some other buyers agencies saying, yeah, you've missed the boat already on this Perth market. So time will tell.
Yeah, I think so. So what major mistake have you made in the past with your investments that you would urge younger people not to repeat as they get into property investment?
Yeah, absolutely. Well, my major mistakes is not about property. Twice in my life, I lost the GDP of a small African nation. I was so heavily geared into shares that one was when the tech crash happened in 2007, and then the other one was in the GFC. I don't know what years it was, but tech crash and GFC. And I'd borrowed a bucket load of money, and you had 30% gearing. So I had 70% debt, 30% equity. And then when the stock market goes down 30%, which can happen like that, all gone. And so I made the decision not to buffer it up. I decided to sell down, and the only advice, my advice number one is to anyone, I always say this on my podcast, 10 with Ty podcast, is never ever borrow money for shares. If you can't own the share outright, don't buy it, right? That's my number one advice to anyone. And the problem with the gearing or the leveraged share portfolio wasn't that they were bad stocks, but what happens is when margin loans start occurring, you have to pile out. And so some of these good stocks, people were just getting margin called, and you just have to sell. To the point, some of these stocks were trading below their asset base, but that's what can happen in the stock market. It can be very fickle.
Yeah. Well, what about the real estate market?
What advice?
Mistakes you've made in the past that you would urge people not to repeat?
Look, I worked out, I've bought 21 properties in my life, and I don't regret one of them, to be honest. I bought a property in Cairns that still wasn't the best performer. It's just because I thought it was cheap. That's probably was the worst investment I made in Cairns. But it still made money. Still made a solid 6% return, but it didn't actually go up in capital value. But I just thought I was cheap, and sometimes cheap doesn't mean best, does it?
What have you bought? Has it always been houses on land, or has it been units and townhouses in the mix as well?
Units, houses, offices, warehouse, but mainly units. Mainly units, and successfully with units. And the house I'm living in right now is probably the best one. It's beautiful. It's in Clovelly.
So mainly attached dwellings.
Yep. There's a couple I've got in Brisbane that are freestanding, but mainly they've been attached dwellings, yep.
That's interesting because so many people are completely wedded to the idea you've got to buy houses on land because they show better capital growth over time than units. You haven't found that.
No, but the difference is the units that I've bought, I always looked at the land ratio, right? So the unit that went, one of the best investments was a unit in Bondi. It was a big block and I only had 3 units on it. So I went, well, the land value, if this place got knocked down, I'm buying this for land value. So you've got to have a high ratio of land to the purchase price. I've never bought a unit in a block of 500, right? They've always been low rise. Maximum was 20, was with the first one in Balmain. But yeah, so there's got to be a high land component in order for that to work.
Okay. Because what I think we're seeing in recent times in the market right across the country is a shift in that dominant paradigm about people preferring houses on land versus apartments for capital growth. We're seeing more and more people opting for attached dwellings for lifestyle reasons, for affordability reasons, all sorts of reasons.
Yep.
All sorts of different buying cohorts, young people, downsizers, migrants from overseas. And I think that there's a shift in the market that we're going to see much better capital growth from apartments.
And I think some of these integrated developments really help that. You know, when you see a Woolworths down the bottom of an apartment block, you speak to those people, they love it. They love going down to the Woolworths on the ground level, then up, get the lift up, you know?
Yeah.
And having, like Meriton's building childcare centres in their places and, you know, shopping centres all within the little community.
Yeah. So real estate is full of myths and misconceptions. What are some of the bigger ones that you think people should be aware of and avoid falling prey to?
Well, the first one is that property always goes up. It doesn't. It doesn't. It goes up if you buy well and timing it well, but the property will always double in 7 years is another myth, sometimes perpetuated by people, funnily enough, selling you property, Terry. So I think you've just really got to be aware of that don't assume your property is always going to go up. So that'll be my experience. Sadly, as I said before, we see a lot of clients where we look at what the original selling price was, what they've bought it for, and they probably bought it at a good time, like 10 years after. So, but then it might start going up then. But the person that originally bought it, 10 years of no growth, and obviously they'd probably be paying out more interest than they're getting in rent, plus the stamp duty, plus their selling costs, lost a bomb.
Yeah. So what mistakes did those people make? They bought the wrong property in the wrong
They didn't do their
location,
research, and
paid
they didn't do their research. They probably relied on someone too much who held their hand all the way. Sometimes, if you're getting your hand held totally by someone getting paid $50,000 to sell you a property, generally speaking, it's not going to be the best investment.
Well, Tyron, thank you.
Thank you, Terry. It's been fun.
It has.
If you own an investment property, then Washington Brown can help you pay less tax with an ATO-compliant depreciation schedule. Visit washingtonbrown.com.au to pay less tax today.